In this learning objective, we explain the importance of macroeconomic analysis in equity valuation. So when we're performing security analysis, it's the process that we're undertaking is trying to estimate some measure of the intrinsic or the fundamental value of a firm. The way we'll often do that is by getting some measure of the firm's earning prospects and getting a measure of the future cash flows of the firm that we can discount back in terms of today's dollars. Now, when we're undertaking security analysis, and if we want to get an estimation of the expected future earnings of the firm, it's important for us to understand the context within which the firm exists. That context is going to be both the macroeconomic context, which is the broader environment, but also the specific industry within which the firm exists. By understanding the macroeconomy and the industry, we can come up with better estimations of those future cash flows. So what we're doing in this analysis is we're applying a top-down approach to security analysis. By our top-down approach, we say that let's start by getting a view of what we think the economic prospects are going to be through domestic and global economic analysis. Then let's have an analysis of the specific industry within which the firm exists and have a view of our thoughts on the prospects of that industry. And finally move down to undertaking some form of company analysis or valuation with a view to those issues. So all valuation models at their heart have a similar feature in that they tend to measure the price of the share as the present value of future cash flows. So any economic variable that might either affect the cash flows or the discount rate will in turn influence our value of a firm. This is relevant because we know that there are strong links between overall growth in the economy and growth in companies' earnings. So therefore, if we're thinking about the company's future cash flows as its earnings, obviously forecasting the economy is going to be beneficial because it can help us to forecast those firms' specific earnings. So as an example of this, what I've plotted on the screen here is the relationship through time between the percentage change in nominal GDP and the percentage change in corporate earnings each quarter between 1946 and 2012. We can see a really clear positive relationship between the two. So that is, as the economy either improves or worsens, that has a strong impact on corporate earnings. Okay, so the nature of this relationship, and the R-squared is quite high, 38%, the nature of this relationship is such that we can see that if we can get a good estimation of how the economy is going to perform, that feeds into providing some estimation of corporate earnings. Now, the problem with forecasting is that it's notoriously difficult. Okay, some famous quotes here that forecasting is difficult, especially if it concerns the future. A little bit ironic. So, economic forecasting, in terms of all the different types of variables that we can seek to forecast, is actually one of the most challenging involved. And there's many reasons for this. Often we're relying on historical data or we have incomplete data sets. Often the economy is affected by unexpected shocks. September 11 is a great example of this. This caused a negative shock to US markets, but it was not something that anyone in advance could have predicted. So therefore, when we use historical data, we could have structural changes such as September 11 or such as big regulatory changes that have a huge impact on what the economy looks like in the future, but can't be predicted through history. And sometimes when we forecast, we blindly rely on trends. So one way that a cartoonist depicts the process of economic forecasting is the following: that really we can have all the sophisticated models and computers in the world, but it really is quite a difficult process to undertake. So why do we forecast at all? Well, despite the fact that forecasting is hard, an informed forecast is still better than none. So as I've got on the screen here, being right 52% of the time is still better than a coin toss. And that's what we're seeking to achieve. We're not going to expect that we're going to be right 100% of the time, but we're going to try to add incremental value to our valuation process. So what values or what economic indicators do we include in our forecast? Well, we should include any estimates of the future macroeconomy. This might include real GDP, inflation, interest rates, and unemployment, and potentially a suite of others. Now, with any economic values, it's important to be able to consider the extent to which those measures relate to the business cycle. And we have three different types of indicators that we consider. So the first type of indicator is a leading indicator. The idea of a leading indicator is that it tends to rise and fall in advance of the economy. These include things like stock prices, money supply, and average weekly hours of production workers. So when these variables tend to be increasing, we tend to find subsequently, or in the later periods, the economy is increasing. So these leading indicators are quite useful as predictive variables. Coincident indicators are indicators that change directly as the economy changes. So these variables tend to be good at getting measures of the current state of the economy. They include things like industrial production and manufacturing sales. Whereas finally, lagging indicators are those that tend to follow or lag economic performance. Might include things like the ratio of trade inventories to sales and the ratio of customer instalment credit outstanding to personal income. Now, while you can argue that lagging indicators have no use in terms of making predictions, lagging indicators do tend to be more reliable than leading indicators in terms of actually modelling the economic cycle. Hence, they can also be quite useful in getting a view as to where the economy has been in the past to track cyclical movements. So why might it be useful for us to go about engaging in some sort of evaluation of the business cycle? Well, we see that, first of all, that the business cycle is linked to industry analysis, and we're about to look at industry analysis in our next learning objective. But what we can engage in is sector rotation, whereby if we can predict the business cycle, one potential investment strategy is to rotate through cyclical and defensive industries based on our predictions of the future cycle. So some examples here: if we predict that we're near the peak of the business cycle, then in those situations price and interest rate pressures tend to increase commodities, and it might be wise to invest in natural resource extraction, so like mining companies, because the price of the resources that they're mining is going to be high. During periods of contraction, when the economy is retracting, we want to invest in defensive or inelastic industries, such as pharmaceuticals and food. When we're near the trough, when we're near the bottom of business cycles, firms are poised for recovery, and it's in this time that we tend to see firms start to consider expansion by making capital purchases. So often this is a good time to invest in capital goods industries such as equipment and construction. And then during periods of economic expansion, we have high growth. People have a lot of disposable wealth, so consumer durables and luxury items tend to be the most profitable or the best industry to be investing in this time. So this demonstrates if we can come up with some model or some forecast of the business cycle, we can use that as an effective investment strategy. Rotation across the cycle can also be relevant in terms of some of the investment styles that we've looked at previously in this course, because there's evidence that the performance of those different styles is cyclical. So size, the small firm investing, tends to be highly cyclical. Small firms outperform big firms during economic expansion and peaks, but underperform during contractions and troughs. So if you can predict the business cycle, you might be able to identify the periods where it's best to rotate your investment portfolio to one that has greater exposure to small firms. Whereas value stocks tend to be defensive. This means that they display counter-cyclical properties. Value outperforms growth during periods of market downturns, but not during expansion and peaks. Momentum's a bit interesting. On the whole, momentum returns tend to be cyclical, so momentum performs better in up markets versus down markets, but momentum significantly underperforms during turning points. So we might be particularly concerned about the peak and the trough, because these turning points in the cycle might be those periods within which momentum suffers big losses. So overall, we can see that it's important for us to consider the macroeconomy as part of our valuation process, and we may be able to form effective investment strategies based on our forecast of the economy.